Hey everybody, this is Halstead and Andrew McMillan with REH CPA. Today we want to talk a little bit about real estate. In the real estate world, it's very important to distinguish whether or not, if you're in that business and you're performing land transactions or real estate transactions, it's important to know if you are what's considered either a dealer or an investor. Which it can be very important. It can be the difference between a 15% tax rate or a 37% tax rate. Andrew, what can you tell us about the differences and what that means?
Yeah, so like you said, you kind of touched on it already with the, if you're an investor and you sell real estate, then you're going to be able to take advantage of a preferential tax rate, a lower tax rate. If you hold that piece of real estate for more than 1 year, then you're going to get taxed at a long-term capital gain rate, which can be anywhere from 0% to 15% up to 20%. So being an investor is a great way to pay taxes at a lower rate. So conversely, if you're a dealer, then you are going to, anytime you sell that real estate, it's going to be taxed at your ordinary income rate. So the way the tax system works, it's a graduated tax system. So the higher your income gets, the higher tax you pay on that portion of income that gets into these higher brackets. So
the 15% sounds fantastic. It sounds like I want to be an investor.
Well,
so how do I become an investor?
So that's where the big play comes in. So it's kind of best understood by understanding who a dealer is. So a dealer is going to be someone who buys a piece of real estate or land, a piece of real estate with the intent to sell it for a profit. These are people who buy and sell real estate for their normal course of business. It's how they provide for their families, how they put food on the table. These are people who are going to be called real estate professionals, people who deal in real estate transactions. So they're going to be viewed as dealers. So think about like home builders, land developers, real estate agents, subcontractors. Those are all going to be people who operate in real estate transactions pretty much 100% of the time to earn a living. So those people, when they buy land, it's viewed as inventory. It's not viewed as an investment. So that's your differentiator there. It's viewed as inventory. So when you sell inventory, it's like you're selling that to make money off of it. So when you sell inventory, you pay taxes at the ordinary rates. So those are your dealers. Investors would be people that aren't that, but this is where you kind of get into some gray areas and some subjectivity because it really comes down to a facts and circumstances test. So investors are typically going to be those people who buy a piece of land with the intent just to hold it as an investment, do nothing to it, and hope that it goes up in value over the normal passage of time. That's kind of at a very tip of the iceberg level. That's who an investor is. The IRS does have a lot of rules that they start to ask questions. Like if you're ever audited, they have a bunch of questions they'll ask you and things that they'll start going through to determine, is this an investment sale or a dealer sale? We can go through a few of those. Really what the IRS is going to want to look at is they're going to look at what was your true intent for when you purchased the property. Was your intent to buy the property and sell it to make a profit, or was your intent just to buy it and hold it and see what happens? That's kind of where it's going to start. The other thing the IRS is going to look at is like, how do you earn a living? What's your daily job? Like what's your W-2 wage? What do you operate in on a daily basis to produce income for your families and for yourself? And how does that relate to real estate? Is there a connection there? Another aspect they'll look at is how many real estate transactions like this have you done? Is this the only one you've done in the last 5 years, or is this the 10th one you've done in the last 2 years? What's the frequency of these transactions that you're operating in? And also, what extent did you take to improve the property? That's usually when you're looking at people who buy a big piece of land. Sometimes they start subdividing it out. They run utility lines. They get it more marketable to sell by sectioning it off and selling it off in pieces. Those are people that are really kind of looked at more of a dealer. So kind of lastly, some things they look at is like, how did you sell the land? Did you go through a real estate agent? Did you market it? Did you promote it? Or did the deal just kind of fall in your lap? Somebody just called you randomly and said, hey, I'd like to buy this land from you. There's a whole facts and circumstances test that you can go through, and you want to get as much of those questions in your corner to help justify that you sold this as an investment and get that lower tax rate on the sale.
Well, that's awesome, Andrew. That's a lot to unpack there.
Yeah.
So, if you are in the real estate business, whether you're a developer or you're flipping houses, and you have questions on whether or not you would be considered an investor or a developer, feel free to give us a call, and we can help you with that. Thank you.